Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Alan House and Nate Aikman. Today we're going to provide an update on the economy and stock market. We will then recommend our one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The nation added an estimated 142,000 jobs in August. That figure was below the consensus calling for 161,000 additions and was accompanied by a sharp downward revision of 86,000 jobs to the prior two-month total. The Labor Department report came on the heels of weak August private sector jobs creation figures from payroll processor, automatic data processing, and a decline in the number of job openings last month. The nation's unemployment rate ticked lower to 4.2%, but it was nonetheless a weak labor market report. Meanwhile, the inflation situation continues to improve. This was reflected in the latest consumer price index readings. Specifically, the CPI and core CPI, which excludes the more volatile food and energy components, increased 0.2% and 0.3% respectively in August, with the latter a bit hotter than expected. However, on a 12-month basis, the headline CPI rose 2.5%, which was down notably from the July reading of 2.9% and the slowest pace since February of 2021. As a result of the cooling economic backdrop, the Federal Reserve reduced the federal funds rate by 50 basis points yesterday. Treasury yields have fallen in anticipation of the Fed reversing monetary policy course this month, but we also think the increased interest in fixed income securities was due to growing fears about the health of the U.S. economy. The price of government-backed bonds, which are viewed as safe haven holdings, moves inversely to the yield. The economic worries were caused by the aforementioned soft labor data and a continued contraction in manufacturing activity. In conclusion, volatility in the U.S. stock market picked up during the first half of September, a month that has historically been the worst for equities. This uneven performance, which included a number of outsized daily moves for the major equity averages, most notably the technology-heavy NASDAQ composite, was triggered by increased uncertainty in the market. There also has been a recent rotation into more defensive-oriented sectors, including utilities. Investors are worried about the health of the economy, the Federal Reserve's near-term interest rate policies, escalating global geopolitical unrest, and an upcoming presidential election. Given this backdrop, we continue to recommend a portfolio consisting of mostly high-quality stocks and cash-equivalent securities. Please refer to the inside back cover of the selection opinion for our statistically based asset allocation model's current reading. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides additional daily content on markets and individual companies that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. And under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for our stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. For those of you that don't know, Value Line financial strength, along with price stability and another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, let's go first to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. Should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. Now, let's go to the screening criteria. The current economic environment remains uncertain, marked by inflation worries, geopolitical concerns, and the possibility of a recession. Many large, well-known stocks have grabbed headlines lately, but we would like to search for other equities with better long-term potential with average risk profiles. So the first filter that we are going to apply is the price growth persistence of 90 or better. We're going to focus on stocks with a price growth persistence of at least 90, and by applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 300. Wow, that's only 278. Okay, the second one is going to be a timeliness rank of 3 or better. The timeless rank is used to predict the relative 6 to 12-month performance of stocks in the value line universe. The format is an easy-to-understand scale from 1 to 5, with 1 being the best performing issues on a relative basis. Most often, stock buyers will want to avoid stocks ranked 4 or 5. And by applying that second criteria, we've whittled the number of candidates down to approximately 180. The third criteria is a 3 to 5 year EPS growth above 17%. This figure is derived from analyst projections of future earnings, and our proprietary valuation method. Our list is now down to 18 possibilities. And the fourth filter is an 18-month target price range midpoint of 25% or better. Now we want to look over the intermediate term, that is the 18-month investment horizon. Scrolling up to the company data section, we're focusing on stocks with 18-month appreciation potential of 25% or better, which is well above the midpoint of our 18-month TPR, which is currently 12%. And by applying this screen, we've chipped away at the list of prospects down to 10, which you can see if you scroll down. And we have, well, you can make a strong argument for any of our remaining candidates, which span a number of different industries, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend nice limited ADRs. And ADRs, it should be mentioned, are simply the equivalent of a common stock for companies that are incorporated outside the U.S. Before I click on NICE, please note that screens can be saved and revisited by utilizing the created saved screen button at the top. And let's see if we can go to the latest full-page report. All told, we think that NICE Limited is a good selection on many time frames. NICE is a global provider of cloud and on-premises enterprise solutions that allow companies to make smarter decisions with unstructured data. It is poised for strong results in coming quarters, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation. Now I'll hand it off to Alan and Nate.
Thank you, Charlie. This is Alan. The first question that came in was, please discuss the PE ratio in more detail and how it can be useful for investing. The price-earnings ratio is the most widely used statistic in investing. If you are like most investors, you will not make a move without knowing the PE ratios of the companies whose stocks are on your short list. In addition, you will regularly check the PE ratios of the companies whose shares you own. The PE ratio is a measure of a company's market value relative to its earnings. In the most basic terms, a PE ratio is the price of a company's stock at the close of the previous trading day divided by its share earnings. Value Line calculates the PE by dividing a stock's current price by an earnings figure that includes 6 months of past earnings and 6 months of projected future earnings. Now let's do an example. Let's say a company's share price is $40 and its earnings per share is $2. Its PE would be $20. If the company's earnings jumped to $2.50 and its price remained at $40, then the PE would be lowered to 16, which would be a more attractive valuation in this case. There is no right or wrong PE. Expect to pay a higher price and accept a higher PE for companies whose earnings are accelerating. The opposite holds true for companies whose earnings are flat or growing slowly. If you think that earnings are poised to take off before the market recognizes it, and the company is maintaining its current PE ratio, you might want to buy now in anticipation of a future earnings jump. In fact, depending on your tolerance for risk, you might be willing to pay a relatively high price for a stock with low or even no earnings in anticipation that it will be a standout moneymaker in the future. On the other hand, if our analyst projects continuing growth for a company, but its PE is already high, you may want to wait for a pullback in price before committing funds so you do not pay a premium based on the total return you anticipate. You'll also find a trailing PE, a 10-year median PE in our data as well. The trailing PE does not consider future earnings. It divides the stock's previous trading day's closing price by the most recent 12 months of actual earnings. Thank you.
All right. Thanks, Alan. I've got a question here asking if we can elaborate on how NICE is organized, what its segments are, and what end markets it serves. And yeah, absolutely. So NICE is organized into two reporting segments. Those are customer engagement, which accounts for approximately 80% of revenue, just going by the most recent annual report. But that does seem to be broadly the trend historically as well. And then there's also financial crime and compliance, which is the other 20%, roughly. So within customer engagement, there are a number of different end markets that are served and sort of product categories. Those are customer experience and contact center services. So they offer their clients solutions to help improve experience for their customers, improve workforce management. And so that has a wide variety of end markets, including telecommunications, retail, banking, utilities, insurance. Basically anything with any sort of large-scale customer service operation is a potential end market there. The second sort of category that's included within customer engagement is actually public safety and emergency services. They have solutions including real-time analytics intended for public safety applications, 911 call management systems, digital evidence management systems for police forces. And so those are primarily aimed, at law enforcement, emergency response, government agencies. So that's also included within the customer engagement section. There's also, just broadly workforce optimization and automation services that they offer within that segment. That includes most of their sort of AI products. And again, very broad end market there. Basically anything that requires any sort of automation. In particular, healthcare, manufacturing, logistics, all big end markets there. They have cloud services within that, and that's designed to assist with sort of digital migration and managing cloud environments. And relatedly, they offer cybersecurity and risk management tools. And those are also going to be very broadly applicable, but of particular interest to companies with, highly at-risk data like financial institutions, healthcare providers, critical infrastructure providers. So all of that is within the customer engagement segment. And then the financial crime and compliance, which again is about 20% of revenues, is much more narrowly focused. They really only do one thing, which is fraud detection and compliance services for financial institutions. So that includes fraud detection, anti-money laundering solutions, and other sorts of regulatory compliance services. And that's aimed at banks, credit unions, insurance companies, investment firms, payment processors, companies like that. And so that is where NICE's money is coming from and sort of how the company is structured.
Okay, thank you very much, Nate. Another question just came in. Someone asked about what is Value Line's target price range? And this relates to the longer term. When your strategy is longer term growth, your goal is to buy stocks with potentially above average price appreciation. Our analyst-derived 3 to 5 year target price range is one of the most important tools for identifying these stocks. Target price range is a forecast of where Vialine expects the average price of a stock to be within the next 3 to 5 years. The range is based on our analyst-informed estimate of company earnings during this period, multiplied by the analyst price-to-earnings ratio over that same period. The difference between a stock's potential high and low prices depends on the stock's safety rank. Expect a stock with a high safety rank to be more stable and therefore to have a narrower band. A stock with a low safety rank is likely to be more erratic and therefore have a wider range. And when I'm talking about a higher safety rank, I mean 1 or 2 safety. With a lower safety rank, it would be 4 or 5, just to clarify that. Also, because the analyst calculates the target price range using an estimate of future earnings based on information available at the time, it is calculated. This measure is somewhat suggestive. As the company's performance changes in the future, the target price range will also be altered. So it's important to not only to keep close tabs on the timeliness rank, the safety rank, the technical rank, but also on the 3 to 5 year target price range. We do look at that variable often, and as I noted, we do make changes to that as it permits. Thank you.
I'm seeing a question here from a Todd asking, Value Line is a core element of my analytics. Why doesn't Value Line update its research more frequently following a quarterly report? Well, first of all, thank you. We're very glad to be of use to you. Second, we earlier in this presentation, the supplementary reports on our website were discussed briefly, and we've actually recently adopted even more aggressive monitoring of the companies under our coverage. So now you can expect a supplementary report anytime there is a 10% or greater movement in one of those companies outside of, our regular coverage reports. So we do actually offer pretty, regular updates. And so if there is a major development with a company between reports, that information will be available to you as a subscriber.
Okay, thank you, Nate. There's also a question from Albert here. Are there any other metrics, ratios you consider in addition to the mentioned criteria? And that all depends on your investment objective. I mean, for this stock, we as a team came up with these factors for the screen, but the beauty of the Value Line screen is you can use any type of screen you want. If you're more conservative, you can focus more on financial strength, safety, earnings and price stability, things of that nature. If you're a little more aggressive, you can look at maybe more growth rate, sales growth rate, earnings growth rate. You can put down, you can put in the price movement of the stocks that are trading, at or below their all-time high or the recent high. There's many different factors that you can use, and yes, we do look at all those factors, but for this particular stock, we use this criterion. And you should also, I might suggest look at, the balance sheet criterion as well. For instance, this particular company has 12% debt to total capital ratio, which by many standards is quite low. And it also has, a good amount of cash on the ledger, which does provide for some financial flexibility. So there's no clear-cut answer to that question, but it is a great question, and there are many factors to look at. It just depends on your risk-return profile. Thanks.
Mm-hmm. Yeah, and obviously, of course, also, obviously you have your goals, but then also it's going to depend what, company you're looking at. Like, not all metrics are going to be equally useful for each different company. Like, to pull the obvious example, like, one of the companies that I cover, DoorDash, I do not look at, for example, the earnings numbers there in the same way that I do some of the other companies under my coverage, because it's a tech stock that makes $0 in profits. But I strongly expect it to do so within the coming years. And so as an investor, right, if you're looking to have a portfolio that's diversified, across different industries, it's worth considering what numbers are the relevant ones for this type of company. What numbers tell the story here? And like, there's going to be a lot of overlap, but in certain cases, some things are going to be more important some places than others.
Great. Thank you, Nate. I don't see any other questions. Nate, do you see any other questions?
I'm not saying anything else that I think we can address today. So,
But thank you all for joining us. We'll now turn it back over to DJ.